let us quickly go back to the markets. And really, we got to look at the NASDAQ because it is on pace for its worst month since November of 2008. Yes, the Dow is up 449 points, but it's really the NASDAQ that needs to claw back a lot more here. It's up 233 points at the moment, but with 4 trading days left in the month of October, boy, that went fast. Is the volatility here to stay? And boy, it's been kind of rough. Or should investors wait for the pain train to pass? Raymond James is a financial services company that provides retirement planning to their clients, many of them high net worth, $754 billion in assets under management. He's here in a Fox Business exclusive, the CEO, Paul Reilly. Let's cut to the chase, Paul. Great to have you. Do you suspect that we will continue to see a new normal now with much more volatility?
Well, first, Liz, yeah, it's great to be back with you here. Yeah, I think there's a lot going in. You came into this last few weeks with stocks trading highly valued. Then you had questions on where's the economy going, what's happening with interest rates, what's going to happen in the election, what's going to happen on trade policy. So it doesn't take much to spook the market and spook people. So, yeah, I think this volatility, as you've seen it go down, probably more than it should have, even if it's a correction. And then this spike like today is going to be more than normal until people feel that a lot of these issues are behind them.
Since, what is it, September 28th, volatility has jumped 86.5%. I mean, it's just been really interesting to see, but you've got to strap on your seatbelts. And so when your net worth clients, whether they're high or middle, when they call you anxious, should they be anxious? What is that advice that you give and how to ride through it?
Well, this is the great time to have a financial advisor because I've heard the saying, hurry up to do nothing when they get the call. It's think about your long-term plan. Don't react to the volatility short-term in the market and look at your particular situation. So we have clients that are liquid or taking this as an investment opportunity. You know, it's not a time to panic and just get out of the market. Even if it's a correction and you're in a position where you're still long-term oriented, you ride through it. If you've got minimums that you have to keep liquid for whatever reason, then you may take a different reaction. But each investor's portfolio is a little bit different. So it's the advantage of having a financial advisor who isn't tied into the motion. All of our studies say investors are way too emotional in their decisions, especially in volatile times like this.
Of the 39% of the S&P names that have reported quarterly numbers, what is getting people a little nervous are the revenue numbers coming in light. Only 60% of the companies have beat on revenue, whereas more than 85% have beat on earnings per share. I don't know. I see that and I say, there's a little bit of trimming and engineering going on to make sure the EPS number looks really good. And then you can't really hide when revenues aren't coming in, when actual purchases and sales money are coming in.
Well, sure. Revenue is always the first key. You can't long-term grow a business without growing revenue, but also people overreact to a quarter. I mean, lots of things go into a quarter. And when you look at expectations, I mean, most of those firms grew, but they didn't meet revenue expectations. So, we've had a lot of just a market, perception, or a lot of analysts just thinking things are going to continue going like this. And typically that doesn't work that way all the time. So I think the numbers are pretty good, not as high as a lot of people wanted them to be, but I thought they were pretty good earnings numbers.
Paul, before we go, and we don't have a lot of time here, you as the CEO of a company that has to report quarterly earnings, do you believe we should get rid of or modernize the quarterly earnings model and make it more of a biannual situation?
Yeah, I think that, first, I'm lucky I'm at a company that's been able to just always look long term, and we really don't plan for the quarters. But there are a lot of people that do. I mean, there are companies that do, but more importantly, analysts used to get measured on 5-year track records or funds, and then they are 1 year, and now they look at the quarters. So I think there's too much pressure and too much cost on looking every quarter. There's too many natural fluctuations, and it's just too quick. Maybe certain data should be released, but to really focus that much on earnings every 3 months doesn't make sense to me.
Paul Reilly, tell the gang at Raymond James down in Florida we said hello. Thank you so much.